All right, so we've talked about the T accounts. Now we're going to talk about the other part to it. It's helper, if you will. The T accounts show us the calculations and what our balance is. What we're going to talk about now, which is journalizing, tells us the story of what happened in those transactions. This is where the language of accounting comes into play. If it doesn't look like this, then it's going to read differently. Think about a foreign language if you learned it in high school. It's not going to make sense if it doesn't look like this. And what we really want is to be able to make sense to the end user. We want to give them that story. So that's what we're going to be doing in this one, which is journalizing. And how to journalize, or what are journal entries. A journal entry is a complete record of each transaction. So they're done one at a time, and they're done in a chronological order in one place. So it's just a long sheet that has all of our debits and our credits in a journal entry form. Again, this is telling the story, not the calculation side of it. The recording transactions in a journal is called journalizing. Again, real creative there. Or what we call recognizing. So if you hear something or it asks you to recognize something, that is dealing with journalizing. Okay. I'm going to show you an example of what journal entries look like, how they work. So let's use this as an example. You invested $3,000 cash into a business in exchange for common stock. Now, first and foremost, I want you to understand this, and I think this is what makes accounting a little bit more tricky than other business classes or subjects, is that we're not a person here. When it says you, you're not doing this for you. We're doing this for the business. We're on the back end of the business. So this is kind of a new way of thinking. You're going to have to put yourself in the business. So really, this is not saying that you invested in it. What we're doing this is, as we, the business, have received $3,000 cash in exchange for common stock. Okay. And so let's look at what our T tables would look like here. Okay. So our T tables, one, cash, because our cash is changing. Ours, the business, is changing. So we're going to put cash. We're going to put our T table. There's our T table. And because our cash is going up, we're going to put it on the debit side. Remember, cash is an asset. Debit is plus side, so we're going to put it on the debit side. So we're going to put in there 1-1, I'm making up some date, and $3,000. Okay, that lets me know on a T-table format that my cash went up by $3,000. Then we also have the other side, because remember, we have double entry accounting. Something else has to happen. We have common stock. Common stock, remember, is minus plus. And our common stock in the business, I know it says exchanging for common stock, which alludes that we're losing something, but our common stock, the value of our business is actually going up. And so we're going to put it on the plus side of common stock. So if we did that, it's going to go there, 3,000, again, 1-1. Those match up. If we're looking at the accounting equation, cash is an asset, so we're saying our assets went up by 3,000. Common stock is an equity, so it's on the other side, it's on the claims side, so our claims went 3,000. So pretty much what we've done is we've said 3,000 equals 3,000, and that's true. So at least we're following the accounting equation. But that's the T-tables. Now let's take a look at what it would look like for a journal entry, because again, this is the specifics. This is how it has to look. This is where the structure comes into play. So this is what it looks like to be a journal. Okay, we have different columns. We have dates. We have account titles. You have document numbers. We're not going to use those. Post references, we're not going to use those. Those are more really in-depth accounting. I'm just getting you through the basics. And then we have a column that's specifically for debit and one specifically for credit. So first things first, we're going to use our date. We want to go ahead and put a date to this, so we're going to go ahead and move the 1-1 there. And then always, 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 when you're journalizing, you always start with the debit. Whatever account is being debited. For us, the cash is being debited. So we're going to move cash down. We're going to put it all the way to the left side of that column. Okay. And if we had other debits, we would continue following them along. We're also going to move our number that's under cash into the debit column. So we'll move the cash, the 3,000 there. Again, that's one line of our debited account. If we had more of them, we would continue doing this. Obviously, we would leave out the date. But the account title, we would just fall in line with that row. We would not move anything else. They would all be in line. Okay, and then we'd keep putting the numbers in the debit. Once we're done with all of our debits, then we move to the credits. And now in this situation, we only have one credit. So what we're going to do is we're going to take that account title, put it right under the debit, and I'm going to indent it just a little bit to show that it is a credit. So now you can look at it specifically, and it says, okay, cash is to the left, so that's debited. Common stock is to the right a little bit, it's credited. If it's both together, it's kind of harder to see. And then I'm also going to put the 3,000 into the credit column. That is what a journalized or journal entry looks like. You have at least one debit, at least one credit. The numbers are apart, so one's under the debit column, one's under the credit column. But that's how you deal with journalizing entries. So you're going to see this a whole lot more as we progress. But that's it.